what if the U.S. job market isn't as strong as we've been led to believe? A stunning new government report reveals that the economy may have created 911,000 fewer jobs in the 12 months through March than previously reported. This revision estimate, released by the Bureau of Labor Statistics, BLS, wrenches into the narrative of steady labor market growth and raises eyebrows about the true state of employment before President Trump's aggressive trade policies took center stage. But here's where it gets controversial. This isn't just a minor statistical tweak. It suggests the job market was already slowing down before tariffs disrupted global trade, and the numbers might be even more alarming than you think. And this is the part most people miss. The root cause could lie in a flawed method called the birth-death model, which might be skewing our understanding of hiring and layoffs entirely. The BLS releases these annual revisions to align its monthly payroll data with a more comprehensive data set called the Quarterly Census of Employment and Wages, QCEW. Think of it as double-checking your math after a rough estimate. This time, the numbers were way off. The preliminary revision shows that instead of adding an average of 147,000 jobs per month, the U.S. actually gained just 71,000. A staggering 76,000 shortfall each month. Economists had predicted a range of 400,000 to 1 million total revisions, so this 911,000 figure is both shocking and, to some, a wake-up call. This means labor market momentum is being lost from an even weaker position than originally thought, says James Knightley of ING. A sentiment that's sure to spark debate. But what's driving this discrepancy? Enter the birth-death model, a statistical tool used to estimate job gains or losses from companies opening or closing. The problem? These businesses aren't included in the initial monthly surveys, leading to potential overcounts. For example, if a local cafe opens in January and another closes in February, the model tries to balance those changes. However, critics argue the BLS has been too generous in its assumptions, especially in 2024. Goldman Sachs economists, while agreeing the labor market has softened, called the 901,000 revision too excessive, noting that the QCEW data itself might have flaws, like undercounting unauthorized immigrants or overestimating job gains in volatile sectors like hospitality and construction. The industries hit hardest by the revisions tell a troubling story. Leisure and hospitality could have seen 176,000 fewer jobs than reported, while trade, transportation, and utilities might have lost 226,000 positions. Even manufacturing, a sector often seen as a cornerstone of economic resilience, could have been understated by 95,000 jobs. Meanwhile, government employment was revised down by 31,000, and only a handful of industries, like utilities, saw modest upgrades. These numbers aren't just numbers. They're a reflection of real people struggling to find work in a market increasingly shaped by automation, AI, and restrictive immigration policies. And now, the political fireworks. President Trump, already at odds with the BLS after firing its former commissioner over earlier job data revisions, has nominated E.J. Antoni, a critic of the BLS, who once suggested suspending the monthly employment report, to replace her. Antoni's appointment has sparked outrage among economists, with the National Association for Business Economics urging leaders to stand with BLS and ensure that America's statistics remain accurate, independent, and trusted. But here's the rub. The BLS's funding has been stagnant for years under both Democratic and Republican administrations. Can we really blame one political party for a systemic issue? Or is this the cost of ignoring statistical infrastructure in favor of short-term political gains? Looking ahead, the Federal Reserve faces a tough call. With inflation data due soon and fears of stagflation rising, the central bank may be forced to act, even as these revised job numbers muddy the waters. Economists expect a quarter-point rate cut next week, but the real question is, how much can we trust the data guiding these decisions? As Elise Gould of the Economic Policy Institute warns, any political retaliation due to today's release will harm the ability for BLS to provide timely and unbiased statistics. So, what's next? The final benchmark revision will arrive in February, And until then, the labor market remains a chessboard of uncertainty. But this is your moment to weigh in. Do you think the BLS's methods are outdated and in need of overhaul, or is the controversy overblown? And if the job market is weaker than we thought, who's to blame? Trump's tariffs, automation, or the statistical models themselves? Share your thoughts in the comments below. After all, the truth isn't just in the numbers, it's in the stories they tell.